You're watching the special broadcast of the MPC decision where the Reserve Bank left rates unchanged. And just to mention that split, 3 voting for a hold and 2 voting for a hike of 25 basis points, where the repo rate now currently remains at 8.25% with the prime at 11.75%. To get into the actual details of that particular speech and that conference, we are joined by Isaiah Mhlanga, who is the chief economist and head of research at RMB. He's not alone. He's with Sanisha Pakirsamy, who is an economist at Momentum. Thank you so much for joining us. Isaiah, let me start off with you. I mean, how would you characterize this particular meeting in terms of hawkishness? Was this a hawkish skip or pause? Because we've tend to be talking about that, especially when we look at the Fed. How are you characterizing this decision?
It sounds like a balanced pause, neither hawkish nor dovish, in the sense that the SARB is sticking to data dependency. They have highlighted that inflation risks remain on the upside, but they're also seeing their inflation forecast moderate relative to the last MPC. So those things, they do balance each other out. But the risks which they point out, which is food price inflation, load shedding, remain. But if you just look in terms of the trends have been positive over the last 2 months. So in our assessment, I think it is a balanced hold.
Sanisha, your thoughts, was this a balanced pause, or how are you looking at it?
Stasia, I'm actually going to edge a bit more to a bit of a hawkish stance on the meeting, because I do think that they did note a couple of risks. The fact that inflation expectations remains elevated. We've heard in previous speeches outside of today's Monetary Policy Committee that fiscal risk plays a huge role also in determining the sovereign risk premium for South Africa and ultimately where neutral rates should settle. So if we look at these elements, I do think that they are still, giving high alert on inflation. Globally, we know that we haven't actually yet won the inflation battle. Underlying rates of inflation are still ticking up slightly. And so on the back of that, I think, it is still a bit of a warning signal to markets that I think the door is still potentially open to slightly higher rates in the future.
Isaiah, based on what Sanisha is saying, how important was this meeting, given that going into the meeting, depending on who you spoke to in terms of economists, many thought that this could set us up in terms of the trajectory of whether the SARB is done or not?
Look, we had expected the SARB to be done, so essentially in line with our expectations. But if you look relative to the May MPC, we had a weaker currency, significantly so. We had a lot of political risks that were embedded in markets because of the diplomatic fallout. And then all of that washed out. But we also had globally the expectations of a US recession. Now that's changing to a soft landing, essentially meaning inflation is falling. The US economy is not going to recession likely. And as a result, the dollar is weakening, which is benefiting the rand relative to the US dollar. All of those factors are positive. What seems to be negative is inflation expectations, which are quite key for the SARB, particularly the longer-term inflation expectations. And then it is the fiscal risks that Sanisha pointed out to. But fiscal risks are not new. They have always been with us. So they are not going to change the trajectory of the SARB now. What the quarterly projection model will do is the SARB is going to be able to articulate them better in their narrative and statements, because they have disaggregated the risk premium to account for specific fiscal risks. But it's not a new risk in itself, because our debt trajectory has been rising for quite some time. So to that extent, it's not a factor that would say it's going to change the monetary policy trajectory on the upside. But I do agree, as far as expectations of hikes relative to cuts, we are still on the upside. In fact, if you just read the statement, it suggests that we are unlikely to see any interest rate cuts anytime soon, because they do also point that globally interest rates are going to remain structurally higher for longer, and that's likely to be the path the SARB is going to follow. So cuts the story of 2024, not this year.
Sanisha, on that idea of interest rates remaining higher for longer, what position does it put central banks in the idea of trying to balance growth, but then also at the same time balance financial stability risks? What are you seeing on that front? Is there a dilemma or perhaps even a trilemma if you add in another factor?
Sure, I think it does place them, in that place between a hard rock and a hard place. And if we look at what's happening globally, we're seeing that underlying measures of inflation are still quite sticky and picking up. And so if we look at that and balance that with still weaker growth prospects, the fact that consumers are under strain, particularly in a number of markets where housing prices have come under pressure because of lower affordability levels, we are starting to see quite a bit of strain in certain markets. But unfortunately, central banks are likely to err on the side of hiking too much in order to rein in those inflationary pressures. And that unfortunately comes at the cost of potentially weaker growth.
Isaiah, I want to come to you with this one. I mean, we had Kuben Naidu, who's the deputy governor of the Reserve Bank, talking about the lag effects of monetary policy and giving that time frame of about 12 to 24 months, that is, and mentioning that it's not quite uniform. From your perspective, given where we are in the cycle, how is everything holding up in terms of conditions on the ground? What are you seeing?
Look, obviously, the lags are difficult to assess. It's not just a South African issue. It's a global issue. Across the world, monetary policy authorities are struggling to figure out how long the time lags are. But what is clear is the 475 basis point increase that we have seen so far in this hiking cycle is still filtering through into the economy. If you look in terms of the cost for servicing debt within home loans, for instance, average house prices that we look at suggest that households are now paying about 4,000 Rand more than what they paid at the height of COVID when the repo rate was at 3.5%. But depending on what house prices you use, that is going to differ from person to person. That is money that is no longer available to be spent on anything else, which means it's going to be restrictive. You can then take other debt types, such as credit cards, overdrafts, vehicle purchases. All of those have increased because mostly within the South African context, it's linked to the repo rate. Every time there's an adjustment, the adjustment is also made by financial institutions higher, and that takes away money that consumers could be spending elsewhere. So that is still filtering through into the economy.
Sanisha, I want to come back to this one, and I know you touched on it a little bit when we were talking about the dilemma of central banks. On a balance of risks here, which is more concerning? Is it the risks of high inflation or the risks of having rate cuts that could possibly kill an economy?
Now, I think going into this kind of environment, we've heard often from our own central bank that the cost of living crisis does hit your lower income household disproportionately. So as my colleague Isaiah pointed out, those consumers that have a home loan or a car loan will see an automatic upward adjustment in their monthly repayment as the rate of interest goes up. Now, your lower-end consumer that's more exposed to your unsecured credit, those levels of credit payments are generally quite high in terms of the interest that you do pay on that, even though it's not linked directly to the repo rate. But these lower-end consumers also face quite a lot of stress in terms of the jobs outlook. And so if we look at these semi-skilled and unskilled workers, we haven't actually seen a full recovery since the COVID-19 pandemic. And so overall jobs in these areas of the economy is still down between 3 and 5%. And so your lower income household has also been experiencing much higher levels of inflation because a bigger portion of their basket is exposed to things like food. About 40% of your bottom 30% of spenders in South Africa, 40% of their basket is related to food items. And so for the past 6 months, your lower income consumer has typically faced inflation rates on average of close to 10%, which is about 3% higher than your upper income earner. And so on the back of this, the South African Reserve Bank has made it very clear that their mandate is to stem rising inflationary pressures in order to protect the more vulnerable households in South Africa.
And Isaiah, I'm glad that Sanisha brought that part up where the Reserve Bank has made it quite clear in terms of their inflation fight. However, when we had the May decision, it was quite critical. I think we had several, publications or rather opinion pieces on various media houses where people weren't quite happy with that 50 basis point move, even though it was unanimous. And some may have described it as an irrational move to move at such a high pace. Walk me through the rationality of the SARB back in May, given the context of these, I suppose, call them critical, opinion pieces that came out, and some even suggesting, offers that may have been a little bit populist, especially when we're trying to balance growth with fighting inflation.
Look, I think the SARB's rationality is very simple. Their mandate is to ensure price stability, keep inflation within 3 to 6%. And at that time, we had inflation that was outside of the band, with a lot of risks that we have suggested is going to come within the band at a very slow pace. So they had to act using the tools which they have, and the primary tools, the repo rate. So they had to act that way. As far as the different consumer side are concerned, poor people that have no exposure to debt would hate inflation, and they will be happy with the SARB that is acting fast enough to bring inflation down. But if you are talking to middle class and high income earners that are exposed to debt, they will be unhappy with interest rate increases. So you have different spectrum of consumers in the economy that are going to respond differently to whatever the SARB does, which means you are not going to get a unanimous view on whether the SARB is doing something good or not. But I think as ourselves that are much more informed than the average consumer, we should know that lower inflation begets lower interest rates in future. So to bring interest rates lower, you need inflation to be lower. And lower inflation is good for the economy in general because it makes the cost of doing business low, but it also means the cost of living is low, particularly for the poor that can respond to higher inflation more easily than the high income earners.
Sanisha, I'm looking at some of the traders on social media, especially tracking the rand movements, and one's even suggesting that perhaps the market would have wanted a 25% basis point hike here, given the response of the rand. What are the risks of over-tightening in the face of, I suppose, call it, forex pressure, currency pressure, in terms of wanting to defend it, but yet at the same time, it can almost have a counterproductive method, so to speak?
So, I think that the risk of over-tightening is very real in this kind of environment, not only for the local economy, but also globally. If you take the US as an example, we've seen, the headline rate of inflation coming down to 3%, where it had peaked at 9%. Core inflation, although it picked up, was the slowest pace in nearly 2 years. And so what you're seeing out of many of these economies globally is that inflation is starting to come down. We are starting to see cracks emerging in the real economy in terms of activity taking a hit from the past impact of these previous interest rate hikes. And so I think that impact of higher interest rates hurting the economy, becomes greater and greater as we get further and further into the rate hiking cycle. And as my colleague pointed out, we've had 475 basis points worth of tightening already in South Africa. Some of that impact has come through already. However, this does act with a bit of a lag, and so we are likely to see further pressure coming through for the consumer and businesses down the line. In terms of the currency, we do operate on a freely floating exchange rate, and the South African Reserve Bank on a number of occasions have mentioned the risks of intervening in the currency and their preference to have a freely floating exchange rate and, the automatic stabilizers that do come through with that.
Isaiah, if we're to talk about, hypothetically speaking, whether you're looking at the Fed or you're even looking at some of the other central banks, including the SARB, what would a policy error look like from your perspective?
Look, it's potentially a hold for now until you assess inflation expectations to be a risk increasingly to the upside, then you can continue to tighten, but otherwise just sit tight. I think the posture of central banks lately has been to take risks on the upside and having to respond late. Remember, they responded late with the assessment of inflation initially, where it was assessed to be transitory or temporary. And then they responded late in terms of actually hiking interest rate, if you look in terms of the advanced economies. So central banks have taken the posture to say it's better to be wrong on the upside in terms of increasing interest rates than to be wrong on inflation remaining high for a longer period of time, because that's difficult to deal with.
Sanisha, in terms of a cut, I mean, would that be the first quarter of next year or the second quarter? What's your model, or what kind of discussions are you having with your team about this?
Now, I definitely agree with Isaiah's earlier statements that I think we're going to see, tighter monetary policy for longer. And that's because inflation risks are still to the upside, like we heard in the statement today. We're seeing that food risks, even though they have brought the food inflation figures down, or the expected food inflation figures down, food risks are still to the upside, given that we are heading into a period of drier weather conditions. We've also seen that the Black Sea grain deal has been revoked, and so that also adds to upside to global food prices. On the oil side, we've seen Saudi Arabia cutting 1 million barrels per day. Russia is expected to cut 500,000 barrels per day in August, and so that also then induces a bit of a demand-supply imbalance in the oil market, again inciting risks on the oil side. So I think for as long as inflation risks remain firmly tilted to the upside, we are likely to see interest rates at a higher level for longer. And so based on that view, my assumption is that we actually get the first interest rate cut, as you say, a bit later, so maybe the second quarter or even the third quarter of next year.